Welcome to the Deep Dive. Today we are taking a close look at Carvana, a company that always seems to generate buzz.
Yeah, definitely. And our mission today is pretty specific. We're zooming in just on the opening remarks from CEO Ernie Garcia during their Q3 2025 earnings call.
Exactly. So none of the deep financial dives or the back-and-forth Q&A for this session. We really want you, the listener, to get the heart of the strategic message. What's Garcia claiming about their business structure?
And maybe more importantly, how does that structure supposedly set them up for these, well, frankly, these incredibly ambitious long-term goals he laid out?
Because the headline claim is just massive. He basically wants everyone to hear that Carvana is now the most profitable and fastest-growing automotive retailer.
Right. And saying both simultaneously is the critical piece. Normally you pick one, right? Go fast or be highly profitable.
Usually, yeah. Growth eats cash, hurts margins, at least initially. But Garcia is saying their model just breaks that trade-off.
And he uses Q3 to try and prove it. He's pointing to profit margins, more than double the industry average.
Double the average, while growing units over 40%.
Mm-hmm. And he makes sure to add that context, that other big public retailers were approximately flat in the same period. It's like they're playing a different game.
Okay, so that's the now. But then there's this future vision, this almost staggering long-term target.
Yeah, the big one, selling eventually 3 million cars a year.
3 million, okay. And not just selling, but selling them at a 13.5% adjusted EBITDA margin.
Right, within the next 5 to 10 years.
We should probably pause on that margin target for a second. 13.5% adjusted EBITDA. What does that really mean in plain English for how they run the business?
Good question. So EBITDA is earnings before interest, taxes, depreciation, and amortization. It basically strips out financing decisions, tax strategies, and how they account for physical assets wearing down.
So it's like the pure operational profit of the core business.
Exactly. It's about how much profit they make just from the act of buying a car, fixing it up, and selling it. So 13.5% means for every dollar of revenue, they'd be generating 13.5 cents of that core operational profit.
Which would be pretty incredible for retail, right?
Oh, absolutely. Among the best in the world, really. Very efficient.
Okay, so how do they even begin to suggest they can get there? From a strong Q3? Sure. But to that level, where does this structural advantage he keeps talking about actually come from?
Well, it starts with what they call the growth flywheel. It's this idea that getting bigger inherently makes them better,
A positive feedback loop.
Precisely. He talks about exponential data growth. More transactions mean way more data, which lets them tweak and improve every little piece of the process constantly.
So more volume, more data, smarter operations, which allows for more volume.
Got it. Can you give a specific example of how that scale helps the customer right now?
Selection's the big one he highlighted. Customers apparently have almost 50% more cars to pick from compared to last year.
Okay, more choice is good. But here's the key part. Even with all that extra inventory, their inventory turn time, how fast they sell the cars, they have stayed approximately flat.
Ah, so it's not just more cars, it's the right cars.
Yeah.
The data is helping them stock smarter.
That seems to be the argument. And scale also funds the physical side, the logistics. They've invested heavily in infrastructure.
Right, like adding reconditioning capacity. He mentioned 15 ADESA locations.
Yeah, over the last 18 months, big build out. And the direct result, faster delivery.
How much faster?
He said they cut customer delivery time by a full day over the last 5 quarters, so systematically making it quicker.
Okay, that makes sense. Now let's clarify this ADESA thing. They also talked about adding ADESA Clear, the digital auction tool. Is that running at the same physical sites?
Yes, exactly. And that's a really important connection. Those 15 ADESA sites are the physical hubs where they inspect and recondition cars. ADESA Clear is the digital auction platform they're layering on top of that within those centers.
And they've got that digital auction running in 12 centers already.
Yeah, that's what he said. 12 so far.
But wait, why focus so much on a wholesale auction tool? Isn't their main business selling cars to consumers, retail? Seems like maybe a distraction.
It does seem counterintuitive at first glance, but Garcia argues it's absolutely central. His point is, if you have the best channel to sell cars retail and the best channel to sell cars wholesale,
then you're just better positioned overall.
you become a systematically better buyer of all cars, is how he put it. They can supposedly figure out which cars make sense for their retail site and get top dollar for the rest via the wholesale auction. This lowers their average cost to acquire any car.
Okay, so it reduces their biggest cost variable, the purchase price of the car itself.
Yes.
Not a distraction, but a core cost advantage.
That's the claim. It connects everything.
So if that's the theory, the flywheel, the integration, then Phoenix is where they're trying to show it works in practice, right? The test market.
Exactly. Phoenix is the lab for these dramatic improvements to delivery capabilities, and they're not just tweaking one thing.
No, it sounded like they're redoing everything. Finance checks, registration stuff, how they stage the cars, the scheduling software, even staffing.
A full process re-engineering, really.
And the results. They shared some numbers comparing Phoenix to the rest of the country.
Yeah, pretty striking. Nationally, maybe 10% of customers get same-day or next-day delivery. Just 1 in 10.
Okay. And in Phoenix?
40%. 40.
Wow. 4 times the rate. What does it take to get to 40%? That sounds incredibly complex.
It has to be. You need the right car, fully reconditioned, sitting in the right place, ready to go the instant the customer finishes the online paperwork. It's intense coordination.
He had that line. Garcia paused for effect, saying customers in Phoenix have about, 2,500 cars ready for same-day delivery?
Yeah, 2,500, just sitting there, available instantly.
That number really paints a picture. It's a totally different buying experience. He called it highly desirable and extremely difficult to replicate.
And that difficulty comes from combining the physical assets, the inspection centers, the haulers, with really deep software automation. Hard for a purely digital player to match, hard for a traditional dealer to match.
But he did caution about the rollout, didn't he?
He was clear it'll take some time to optimize the rollout across the country. They want to get it right, market by market. Precision over just pure speed of expansion, it sounds like.
Which makes sense, given the complexity. And that optimization really depends on the next big piece, the automation underneath it all.
Absolutely. You can't deliver that kind of speed and scale if humans have to manually review every step.
You gave some metrics on that, on customer self-service. How is your customers doing themselves now?
Pretty impressive numbers. For people buying a car, over 30% apparently go through the entire online process without talking to a human advocate until the very end, the pickup or delivery.
1/3, basically touchless until a handover. That's significant.
Good.
And for people selling their car to Carvana.
That number jumps even higher, over 60%. More than half the sellers complete the whole thing digitally.
60%. Think about that compared to walking into a dealership to sell your car. It's a world apart. What kind of tech backbone does that require?
Well, he laid out the recipe. First, you need that vertical integration we talked about, controlling the process end to end.
Okay.
Second, your data has to be clean, organized, and instantly available. No data silos.
Right.
And third, this is maybe the trickiest part, decisions need to be deterministic and automated. The system has to make the right call algorithmically without needing a person to double-check constantly.
So predefined workflows, smart automation, all wrapped up in an easy-to-use website or app.
Essentially, yeah. Build the machine, let the machine run. And the goal, he said, is to use this automation to find fundamental gains in every line item.
Making it simpler and maybe even fun for the customer, while also cutting costs and making the business itself more efficient.
The classic win-win they're chasing, better experience, lower cost structure.
Okay, which brings us to the final point he raised. Maybe the most surprising constraint.
Yeah, prioritization.
Right. He said the hardest part of moving fast isn't finding good ideas or even the money. It's deciding which of the many opportunities to tackle first. Why is that the bottleneck now?
Because the pace of change is just relentless. Technology keeps improving, customer expectations keep rising, so new ways to get better are constantly popping up.
And then he specifically mentioned AI.
He said, with AI, this is more true today than it has ever been.
Meaning AI isn't just another tool, it's like an opportunity accelerator.
Exactly. It's generating potential improvements, tiny pricing tweaks, better inventory forecasts, smarter logistics routes faster than they can possibly implement them all.
So the challenge isn't a lack of innovation, it's almost an overabundance of potential projects. Their internal development teams can't keep up with the fire hose of AI-generated possibilities.
That seems to be the implication. It's a high-class problem, for sure, but it means making tough choices about where to focus limited resources. Interesting.
But despite that challenge, he sounded pretty bullish at the end.
Oh yeah, very confident. He reiterated the big goal, 3 million cars, 13.5% EBITDA is very achievable.
And it's saying the team is excited and isn't tired. Ready for the next phase.
Full speed ahead, apparently.
Okay, so let's try to synthesize this for everyone listening. Garcia's core message from these opening remarks seems to be, look, our Q3 results prove our model is different. The flywheel, the integration, the scale, the automation, It works. We can grow fast and be highly profitable simultaneously.
Right. He's saying the foundation is built and proven. Now it's about scaling that proven model and optimizing it relentlessly. These structural advantages are the engine for that huge long-term target.
It's definitely a bold vision. So here's something to think about. Garcia highlighted that AI is creating new opportunities faster than they can even act on the old ones.
Right, that prioritization bottleneck.
Yeah. Exactly. So for a company that's all about speed and efficiency, how much does their future success hitting that 3 million car goal in 5 years versus, say, 10 years now depend purely on their ability to choose the right projects? Is the main race now internal discipline versus the overwhelming external opportunity AI keeps creating?
That's a fantastic question. How well can they filter the signal from the noise when the noise is getting exponentially louder? A real strategic challenge.
Definitely something to keep an eye on.
Okay.
That wraps up our deep dive for today. Thanks for tuning in.
Catch you next time.